Well, hello and welcome. You're tuned in to CNBC-TV18 Prime, and you're tuned in to the Big C, where we discuss commodities, currencies, as well as cryptos. Well, I'm Nigel, and with me is Manisha. Manisha, what do we have on the radar today?
Well, you can't take your eyes away from the action in the oil. The markets and the week-long conflict between Israel and Iran show no signs of respite. We'll talk all things crude prices, demand and supply with Sushant Gupta of Mackenzie. We'll also take stock of the rising edible oil prices. Can India's recent duty cut on imports help shield domestic prices and boost supply significantly? SD Guthrie, Sandeep, Bhan will be joining us later on the show to take that discussion forward.
Well, and in terms of handover from Wall Street, well, stock futures are under pressure. Futures tied to the Dow Jones Industrial Average are down close to around 90 points or thereabouts. Remember, regular trading, of course, was shut, as we mentioned yesterday, on account of Juneteenth.
Oh, well, absolutely. The conflict between the regional adversaries, Israel and Iran, escalates and has now entered its second week. Iran has launched strikes on southern Israel. Meanwhile, we understand that the Iranian Foreign Minister Abbas Araghchi is scheduled to meet his counterpart from France, Germany and the United Kingdom in Geneva. This is done to address course of country's nuclear program going forward. And the latest comments from Hezbollah Secretary General Niam Qasem has said that threatening the supreme leader of Iran is seen as aggression against people of the region. Statement from the White House now confirming that Donald Trump will in fact take a call on U.S. involvement in the ongoing conflict over the next 2 weeks due to a chance of negotiation. On that note, let's hear out a word from the White House Press Secretary Caroline Leavitt.
Now, regarding the ongoing situation in Iran, I know there has been a lot of speculation amongst all of you in the media regarding the president's decision-making and whether or not the United States will be directly involved. In light of that news, I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks." That's a quote directly from the president for all of you today. So the president is always interested in a diplomatic solution to the problems and the global conflicts in this world. Again, he is a peacemaker in chief. He is the peace through strength president. And so if there's a chance for diplomacy, the president's always going to grab it. But he's not afraid to use strength as well, I will add.
Well, in Harvard University's Kenneth Rogoff also spoke on the role of the United States in the ongoing Iran-Israel tensions, and says that unsuccessful U.S. strikes could accelerate a nuclear threat. Let's listen in.
I think the majority of people think that this is a bottomless pit if the U.S. gets into it, and that if the U.S. isn't prepared to occupy Iraq, God forbid, and even if it's successful in bringing down the regime, you're going to get something like happened in Syria or Libya afterwards. And if the U.S. strikes and it's unsuccessful, it doesn't get rid of the nuclear bomb, it will accelerate it. It's an absolutely critical moment in Trump's second presidency. This could be one of the couple biggest decisions that he has to make. There's no great answer. Iran is a big problem. There was really a strong case for Israel to do something from its perspective. But for the United States, this is a tough call, and it could lead to a lot of market volatility if the action really heats up. I think it's more likely than not that Trump is going to move on this, that he really does believe that if Iran gets a nuclear bomb, it's an existential threat to the world. But on the other hand, European information, British information really was that Iran was not yet building a bomb. A very tough call. But I do think it's more likely than not that he strikes. It's his instinct, it really is to want to negotiate. But he's up against, a rather ideological foe who doesn't really want to give anything, no matter how dire the situation.
Well, shifting focus to stocks in Asia Pacific, which are trading mixed in trade as we speak. The Nikkei shut sharp in the red, down close to around 0.2%, while the Shanghai too takes it on the chin. It's down close to around 0.2%. Now, we miss other important news flow. The PBOC has acted in line with expectations, keeping its loan rates unchanged at around 3% for the one-year loan prime rate and 3.5% for the five-year LPR. Back home on the Lal Street, it's a good day of trade actually. After a while, after the last few trading sessions of a bit of consolidation and a negative bias, the Nifty is holding above the 24,900 odd mark, and it's been challenging the 25,000 mark for majority of the trading session. But turning our attention to the money markets, then the dollar index is set to close the week rather upbeat, buoyed by safe haven demand. Persistent geopolitical worries this week, coupled with the Federal Reserve leaving interest rates unchanged, has fueled the appetite for the greenback. Well, the US currency is poised for a 0.5% gain this week, but the big talking point really is the action in the oil space. Manisha, tell us more. We woke up to higher crude prices, but from the top, it's again seen some profit taking.
Oh, well, yes, there are big swings coming in for the crude oil prices. We did see 3% of a gain in the overnight markets there. And yes, after that, there's a bit of a decline that we're looking at in the prices. Well, the geopolitical risk premium is what seems to be building in markets. We're now looking at a mild pullback. Brent now down nearly 2.5 to 3% on your screens there. The US is weighing on its involvement in the ongoing war. It's a two-way story, actually, with prices are fetching their uptick from that risk premium concerns over an impending oversupply situation in the next year is capping those gains as well. Let's also keep it with crude. I also caught up with Sushant Gupta. He's director at Mackenzie, to make sense of the crude narrative as geopolitics assumes center stage. Where is crude likely to peak during the current geopolitical premium in mind, and are those levels likely to sustain over the long term? Answers to all of this and lots more. Take a look.
In the last few days, the initial fear of loss of supply from the Middle East has gone away slightly. So prices are seeming to be stabilizing around $74 to $75 per barrel now, which in our view is carrying a risk premium of around, close to around $10 per barrel compared to our base case view of a June prices before the attack.
How are you looking at the situation unfolding now, Sushant? Because Strait of Hormuz really seems to be in conversation right now, though it only has once before been perhaps choked. But from where we stand right now, and all eyes really on whether or not it will happen yet again.
Well, I think it's a very tricky and an uncertain situation, for us as well. So at the moment, we believe that the extreme scenario which you painted out is less likely. And the main reason for that is, if in the event, right, Iran tries to, choke the Strait of Hormuz or, start to impact the tanker flows from the Middle East, we would see that would involve a larger response, from the US. And that is, I think, one of the biggest worry for Iran. Second, Iran will itself be isolated even further, and it will reduce any chance of diplomacy, for itself. Iran's own revenues will also start getting impacted, from its huge amount of oil and gas exports. That will again impact its own position, and the overall global economic growth will be severely impacted again, having other people involved in this crisis. So I think we do see the impact of that will be very, very severe. That could take the prices to close to $100 per barrel. But the chances of that happening, obviously, we are still maintaining it's low at the moment.
Sushant, I agree with you. There's just so many ifs and buts right now. There are reports of various case scenarios where the crude could go to 100 or could go to 50 on the lower side as well. By the time it's second half of this year, what is your sense? Because the swings are really high. We've seen what happened in the previous week and how the crude is trading in this week.
Well, I think so. If you take out the situation, the extreme situation we discussed, right? I mean, if the Strait of Hormuz remains open, and also we, assume that this particular conflict will not be long drawn. It will not involve a lot of other players, right? If we take that as an assumption, the crude oil markets are fundamentally oversupplied. We could potentially see, oil prices coming down, lower much faster if, apart from this conflict. And OPEC is already producing, more crude in the next few months. That could again take the prices down. So, although the risk premium, which is currently in the market, will not be so high, it will still remain in the market. So we are forecasting prices to be in the range of around $60, $65 per barrel. in the quarter four period, right? If this conflict is resolved and doesn't escalate further and doesn't involve, doesn't becoming a much more broader regional or global conflict.
Sushant, how are you also looking at Asia impact of this? We've seen India demand growth continue to be on the stronger side. How do you look at Indian demand growth for this year and the next as well? And do you see any impact at all from what's happening around the world?
Well, I think so. The India's demand growth is very robust. We are very positive about the India's demand growth compared to other countries this year, particularly China. So we expect around 100 to 150,000 barrels per day of growth in India's demand growth. But the impact of this crisis, could potentially have a significant impact because India currently imports around 90% of its crude oil, and 50% of it comes from the Middle East. So it is definitely, exposed in that sense. So India, one from the absolute price perspective, and second is the freight, right? The freight also will potentially go up, and it's already gone up by more than 20%. So the delivered cost of crude to the India, delivered cost of energy to India will increase quite significantly. That could have an impact on its GDP growth and hence the demand growth. So India potentially will start looking for diversifying its crude oil supply sources from non-Middle East sources, particularly Africa and even Latin America. And the other impact it potentially coming from, essentially the consumer prices will go up, right? Because the crude oil prices are going up, and hence the marketing companies such as Indian Oil, HPCL, BPCL will not be able to pass on the cost to the consumers, and hence their profit margin, their revenues will start getting impacted, from a squeeze from high crude prices and not being able to pass on the cost to the consumers.
Well, absolutely. Sushant, the other thing really is about tariffs, and we've seen that continue to move crude prices on a daily basis up and down as well. We understand that US and China are talking, US, Canada perhaps are also talking. Do you see that as a premium in crude prices also currently being built?
Well, I think obviously as we're heading closer to the 90-day period, right? So we have almost around 3 weeks now left for the 90-day period, which was agreed between Trump and most other countries. We expect, and not a lot of deals have been done. We obviously a lot of discussions are ongoing. So as we head towards that, and if those tariffs come back in the market again, we could potentially see a larger fear of demand destruction, right? I mean, I think on the flip side, demand could potentially be much weaker than what we expect at the moment of around 0.9 million barrels per day of demand growth for this year. If those tariff or the reciprocal tariff come back in the market after the 90-day expiry of the 90-day period. So that's on the demand downside. We don't expect sort of a implication on the oil prices and on the upside, but more on the downside from the return of those tariffs.
Sushant, when you talk about the global consumption numbers like that, how are you looking at overall numbers, global consumption and global production for this year and the next as well? I mean, we understand a lot of numbers are being thrown from World Bank to IEA to OPEC as well, but what is Wood Mackenzie's in-house numbers for this?
So I think, first of all, our assumption is that the pause which the US and other countries have taken for the 90-day remain paused, right? We don't expect the reciprocal tariff to come back in the market. So the countries which are currently negotiating, strike a deal with the US in some shape and form. And with that assumption, we are forecasting global oil demand to grow by 0.9 million barrels per day. Now, this compared to the production or supply growth is much less. So supply growth is roughly around 2.5 million barrels per day, almost 1.3 from non-OPEC, around 0.9 from OPEC, right? So there's quite a significant difference between the demand growth and supply growth. And hence we were forecasting a much lower oil price for this year, averaging around $62 to $65 barrel for the quarter 3 and quarter 4 of this year. From a fundamentals perspective.
Got that. Sushant, going forward from here, it's currency moves as well. Economic data is something that the street will watch out for. Interest rate cuts, perhaps going forward. What is it that you're looking at in sense of crude prices that can impact the market here? And what is also your range now for this year and next?
So I think, again, it's quite difficult to call out in terms of what will happen to the Iran and the Israel conflict. I think that's one of the biggest things to watch out for at the moment. how will US play the diplomacy, or Iran, for that matter, discuss this and how we see this conflict growing and how long it will last, right? And that's the biggest question mark at the moment for the oil market. But as I said, if we remove all the extreme, situations, from the market, we expect oil prices could potentially remain around 70 to 75 in the next several weeks, assuming some risk premium, but again, not to the same extent as I talked about in the beginning. But again, to some extent, we expect prices, risk premium to remain in the market, and the prices could be in the range of 70 to 75 in the next several weeks. Now, after assuming this conflict get resolved, we could potentially see prices for the quarter 3, quarter 4 in the range of around $65 per barrel for Brent oil.
All right, that was interesting conversation from Sushant Gupta, who says that for the near term, you could be looking at prices to the range of $76 to $78 a barrel. But an average for this year clearly is between 62 to 65. So expecting the crude prices to come off by the time we end this year. Well, with that, it's time for a short break on the show. On the other side, we will take discussion forward with Sandeep Bhan on edible oils in international markets, which are getting impacted on various news and information there, and of course, the way forward. Welcome back. Let's welcome our second guest on the show, Sandeep Bhan. He's CEO, SD Guthrie. Sandeep, hi, thank you so much for joining in. And there's just so much happening in your part of the world as well. The way we've seen the crude oil prices surge also has taken a lot of edible oil prices on the higher side with itself. We do understand that 20% of vegetable oils are now used as biofuels, and especially with the latest bill proposed in US, which does put that number on the higher side. How are you looking at this linkages of crude oil prices with edible oils?
You see, the higher rise in the prices and geopolitical tensions, plus the U.S. biofuel blending, is definitely having a significant impact on the oil prices. And palm is not left behind. Palm had become very cheap compared to soybean oil, but now soybean oil is very firm because of this blending news, and that gave big boost to the palm prices. Palm has not recovered in tandem with soybean oil, but it has still managed to get a very firm support from these two news. So I can say we are borrowing strength from outside markets than on palm's own fundamentals.
Hi, Sandeep. Welcome to the show. Thanks a lot for joining in. Well, you have to, give us an upward trajectory on both these two. Where do you see both of them headed?
You mean palm oil prices?
Yes, palm oil prices, which are up, I think, in the last month or so, they're up nearly around 4 to around 5% or thereabouts.
So palm has now reached to 4,100 on the futures market here.
Yes.
At 4,100, we are seeing bit of a selling and bit of a slowdown in the demand. So we have to see whether palm will be able to break decisively 4,100. That will depend a lot, again, on these two major factors of US biofuel news continuing and this geopolitical tension. Ideally, it looks like 4,200 is going to be the next immediate target.
Sandeep, also comment on the fact that many countries now are using vegetables oils as biofuels, whether it's about US, Indonesia, we've been talking about a lot of time now. Even Thailand, there have been some statements. Brazil is another one right now. How are you looking at this fuel, food kind of a debate that continues in? And going forward, if you had to throw a guess, next 5 or 10 years, what kind of numbers could we be looking at?
This sector is only going to grow. In fact, I can give an example of India only, because after India's duty revision, we are basically taking close to 300,000 tons a month and close to 2 million tons a year RBD olein out from the system. And this RBD olein is now back in, which was mainly being shipped from Indonesia. So Indonesia has to find an alternative markets for this 2 million tons a year. Likely chance we will be moving much faster to B50 than B40.
Oh, well, absolutely. That really takes a lot of vegetable oil away from the market and into a biofuel as an economy. The other important one, Sandeep, is about the EU deforestation. I mean, we've been talking about it for the last couple of years, but it does seem like that it would be implemented on 1st of January 2026. How do you see various countries now complying to this?
We see industry has already started preparing for it. We see it coming and we are getting prepared for it. And we can see that our global customers will also now started asking about EUDR. So it looks like it is coming.
Do you see any possibility that it gets postponed a little bit and there is some leeway that's given?
looks like unlikely it's going to, it looks like it's coming. The way things are shaping up and the way our customers are asking, it looks like it's coming.
And Sandeep, when you say that most countries are now working towards it, what does that really mean? Is it about showing more papers? Is it about complying to it? How is it being done in various countries, whether it is about Asia, whether it's about European countries, even India for that matter?
So it is basically complying with the requirements that EUDR has come up with a revised ruling recently by categorizing 3 risks: low risk, standard risk, and high risk. Low risk is something which they have said is going to be managed. It's only the high risk and standard risk which will need more due diligence. But the countries they have put into these standard and high risk will have to give a lot of documentation.
And how would you look at India, Sandeep? Because there are hardly any forests here, and we're not even degrading forests or cutting forests. So for Indian markets, would that mean it's more about paperwork, giving in more evidences than anything else?
I think India stands to gain from it, and particularly if we look into from palm oil perspective, which is coming from the local plantation, that's already RSPO and compliant with the EUDR. So that should be an advantage to the Indian industry. Besides that, also it's more documentation for India as a whole.
Sandeep, when it comes to India, as you said, and me and Nigel were discussing it before the show, that is it about just plain edible oil, or is it also going to be about edible oil used in various snacks that could also be under the purview?
Well, that's right, Sandeep, because that's an interesting part, since many companies that we speak to, they talk about the big export opportunity as well in terms of snacks and namkeen and various other products. So, do you think it'll be further stretched to the finished product as well?
As far as my understanding goes, and from the customers that we deal in, it definitely is up to the finished product.
So, Sandeep, all those snacks and those chevras and farsans that India perhaps exports, do you think it's going to be a big one or a big knock on all of these as well?
So these guys have to be prepared for it. They have to come up with the documentation.
Sandeep, since you speak to a lot of people in India and various other countries as well, how are people complying with this?
So I haven't seen yet from anybody from India asking for the EUDR compliant. I think India is still behind it.
Okay, India is still behind this. I was talking to coffee guys, and I've been talking to edible oil guys in India as well. One, they say it's a tedious process. Second, it's about time consuming and money consuming as well.
It is a process driven. It has a lot of documentation and stuff to be done. But once done, it's going to make them easy.
Sandeep, coming on a number, I just want to go back on, again, the way the edible oil is used as biofuels. Globally, 20% of vegetable oil is used as a biofuel. How much higher do you see that number going in, let's say, next 5 years?
Won't be surprised if it goes to 25 to 30%.
Sandeep, also, what's your sense on the prices going forward? Palm, you've already told Nigel, but the way we see all the edible oil prices moving and a consensus emerging that we are headed to higher vegetable oil prices from here, how are you looking at that?
See, like I say, it's a lot of borrowed strength from the geopolitical crisis that will determine which way the prices will go. As of now, it looks like if we go palm specific, we are at its some levels, which is a borrowed strength of 4,100, maybe 4,200. But the big factor is the US biofuel policy, which restricts soybean oil exports from US and makes us completely dependent on Brazil and Argentina, and partly on the Russian flow also. That is more of a near term, and then later part of the year, we'll see sunflower oil also coming. So bottom side bottom is well protected because of this crisis. Upside will remain because also these higher crude oil prices have gone into the freight market. Freight has now jumped higher. So that overall makes that US dollar terms prices bit higher.
Sandeep, I'm optimistic that there can be some kind of de-escalation in terms of the geopolitical issues. That's good, right, for all sorts of markets, equity markets, risk-on assets, as well as good for humanity as well. If that is the case, then what do you think? What happens to these prices? They cool off a little bit?
It will cool off a bit, that is for sure. And if it has to cool off, it has to cool off within July, August, September, particularly palm, because this is the period where we have a seasonally higher production months. But once we go into the lower production months, that is closer to the end part of the year, that's where the prices will get again, prices will again see an upside.
Sandeep, I also want to pick your brains on the fact that even as the US and China trade agreement conversations are happening, there is no mention of soy therein yet.
Yes, that is, this year China is surprisingly very quiet on all fronts. We have seen even in palm oil also they are very quiet. China is not coming into the market in an open way the way it used to be. That's clearly visible from the trend we are seeing in the markets.
Sandeep, a final question then. And even as we see inflation easing for many of the other agriculture commodities, would you say it's not the case for edible oils?
Edible oils have this biofuel support which keeps the prices at a higher level. So there's not going to be much of a downside that we can say which can reduce this edible oil related inflation. In fact, actually, what I understand from my foreign friends in India, they tell me there's not much of an inflation because of edible oil, because edible oil prices are already way cheap.
All right. But I take your point well that as of now, 20% of vegetable oils are used as biofuels, and that could only go higher to 25, as you said, Sandeep, in the next 5 years or so. So that is a market that to keep a watch on. Thank you so much for joining us. And that's all the time that we have on the show from me and Nigel from the Big C. Until tomorrow, when we get you more updates and more news on the same.